Let's set the scene here. We are standing right at the edge of a massive economic frontier. I mean, over the past few years, we've witnessed an absolute historic gold rush into artificial intelligence. We're talking trillions, yes, trillions with a T, flowing into the servers, the silicon, and the software that's supposedly going to power our future. But beneath the surface of all these gleaming, futuristic data centers and skyrocketing stock tickers, well, there's a serious tension brewing.
It brings up a really dangerous question. What if the most exciting technology in human history is also the biggest financial bubble ever created? I mean, from trillion-dollar valuations to just unprecedented investor hype, some of the top experts out there are asking, is this AI boom actually sustainable, or are we literally watching a bubble inflate in real time? So let's dive into this explainer and unpack the data, the history, and the frankly staggering numbers behind the AI revolution.
Part 1. The trillion-dollar hype. Let's look at the completely unprecedented scale of AI investment. To put this into perspective, in 2025, artificial intelligence startups absorbed a staggering 61% of all global venture capital funding. Just to give you a baseline, that was at 30% back in 2022. So what does this actually mean? It effectively means the vast majority of the world's speculative capital is crowding into one single sector. Every other industry on the planet is left fighting over the remaining 39%. It's like a giant financial black hole.
And you have to hear these private valuations from early 2026. They are just wild. OpenAI reached a mind-bending $730 billion valuation. Anthropic? They hit $380 billion. And to fuel that insane growth, OpenAI actually closed a $110 billion funding round. That's the single largest private funding round in the history of finance. We're not just talking about big numbers here. These are completely unprecedented in the history of private markets. Section 2, Anatomy of a Bubble. We need to compare this AI boom to the infamous .com era. First off, let's ground ourselves in what we're actually looking for here. What is an economic bubble? Well, it's a period where market valuations become totally stretched and the prices people pay for stocks completely disconnect from fundamentals, reality, or, actual underlying earnings. Simply put, it's when investors are paying for a really good story rather than the actual cash a business is making. So, a crucial starting point is comparing the poster children of both of these eras. Back in 2000, Cisco was the absolute darling of the dot-com boom, right? They were building the internet's literal infrastructure. They hit a massive $370 billion market cap, but, and this is key, they had extremely low profit margins. Fast forward to 2026. NVIDIA is the one building the AI infrastructure. Their market cap hit roughly $4.3 trillion. But here is the massive difference. NVIDIA generated over $215 billion in revenue with a staggering 53% net profit margin. So for the bulls out there, this isn't just a speculative narrative, it's backed by a literal mountain of real cash. But let's zoom out and look at the broader market data side by side. The forward price to earnings ratio during the dot-com peak was way up around 60. Today, it's sitting at a much cooler 23. Also, fewer large-cap tech companies are unprofitable today compared to back then. However, take a look at that market concentration. The top 5 companies today make up about 30% of the entire S&P 500 index. Guys, that is the highest market concentration we've seen in half a century. If those few AI giants stumble, they're taking the whole global market down with them. Section 3. Why this is different. Let's look at tangible value and enterprise adoption. Just look at the enterprise adoption rates for generative AI. It's skyrocketed from under 9% in 2023 to a whopping 71% by 2025. Businesses aren't just, talking about AI in the boardroom anymore. They are actively plugging it into their daily operations. That real-world utility drove enterprise spending to an estimated $37 billion. And it's definitely not just corporate adoption either. We're talking massive consumer scale. OpenAI boasts 800 million weekly active users and over 1 million business customers. That pulled in roughly $13 billion in revenue for 2025 alone. Think about it. During the late 90s, a lot of those hyped-up websites had 0 users and 0 revenue. Today's AI tools are already woven into the daily lives of hundreds of millions of people, and they're generating massive cloud revenues across AWS, Azure, and Google. Section 4. Cracks in the foundation. Let's talk about the warning signs and some seriously unrealistic expectations. You really have to listen to the people actually building this technology.
Ali Quadsi, the CEO of Databricks, which, by the way, is a company valued at $134 billion, he explicitly called the current environment a peak AI bubble. Even OpenAI CEO Sam Altman has echoed similar warnings about overheated investor sentiment. When the very architects of the boom are out there telling you things are getting a little rational, yeah, it's probably wise to listen.
Let me show you exactly what market fragility looks like in the AI era. $588.8 billion. That is the exact amount of market value NVIDIA lost in a single day during the DeepSeek shock in January 2025. Basically, a Chinese startup released an incredibly efficient, low-cost AI model, and the market absolutely panicked. It proved that even the strongest AI giants are highly, highly vulnerable to sudden technological shifts. You know, everyone loves to laugh at Pets.com from the year 2000. They spent millions on those little sock puppet ads, generated literally zero profits, and vanished. Now, obviously, OpenAI is completely different. They have revolutionary, world-changing technology with 800 million users. But here's the catch. Despite billions in revenue, OpenAI projects it won't see a single dollar of actual profit until 2030. And to get there, they're projected to burn up to $47 billion annually. Even with world-class tech, that is a historically precarious path to profitability. And beyond just the cash burn, speculative behaviors are honestly running rampant right now. We're seeing startups being valued anywhere from $400 million to over $1 billion per single employee, no joke. We're also seeing these complex circular financing deals where AI companies are essentially just buying revenue from each other to inflate their numbers. The hyperscalers are taking on massive debt loads to fund their data centers. And despite all those big promises of productivity, we've seen 55,000 AI-attributed layoffs, which just goes to show that integrating this tech into the real world is incredibly messy.
Section 5. The Revenue Gap Reality. This brings us to David Kahn's $600 billion question.
Okay, let's walk through the math here because this is absolutely crucial. Step 1, big tech giants like Microsoft, Google, and Amazon are committing somewhere between $650 to $700 billion in capital expenditures just for 2026 to build out these AI data centers. Step 2, to actually justify that massive hardware spend, the software running on those servers needs to generate about $600 billion in end-user revenue. Step 3, actual end-user revenue across the AI space right now is hovering around just $100 billion. The result? You're looking at a massive $500 billion structural revenue gap. So why exactly is that end-user revenue so low? Well, MIT research published in August 2025 dropped a bit of a bombshell. They found that despite throwing billions at the technology, an astonishing 95% of organizations are getting zero, yes, zero, financial return on their generative AI spending. The infrastructure is being built at light speed, but the profitable enterprise applications needed to actually pay for it, they just aren't there yet.
Section 6. If the bubble pops. Let's look at the fallout scenarios for the global market. If a correction actually triggers, the fallout could be genuinely severe. Because the S&P 500 is so heavily concentrated in just a few tech giants, a drop in AI valuations would absolutely drive a broad market correction. We'd likely see a wave of debt defaults from over-leveraged infrastructure startups that took on way too much risk to buy those expensive chips. Capital would rapidly rotate out of mega-cap tech and retreat into safer, cyclical value stocks. And ultimately, we'd see widespread consolidation, with the smaller AI pure plays either dying off completely or just getting swallowed up by the giants.
And look, the smart money is already sweating this. Recent surveys show that 54% of global fund managers now believe that AI stocks are actively in a bubble. That means it has officially become the top tail risk to the global economy in the eyes of professional investors. This anxiety, it's not some fringe theory anymore. It is the majority consensus. But, and this is the absolute crucial point you should take away from our explainer today, a popped bubble does not mean the end of AI. Not at all. Just like the dot-com crash wiped out the Pets.coms of the world, but ultimately gave us the modern internet, a selective correction in AI would wipe out the unprofitable, hyped-up startups. But the fiber optics, the data centers, the incredibly advanced microchips, that infrastructure stays. The cash-rich giants will survive, and they'll use that hardware to build a genuine, long-lasting productivity supercycle. So here we are, literally standing at the crossroads of history and hype. We've got record-breaking profits sitting right alongside record-breaking cash burns. We have genuinely world-changing technology mixed with just irrational exuberance. So I want to leave you to ponder this one thought. Will artificial intelligence smoothly reshape civilization over the next decade, or must it first suffer a brutal crash to become another dramatic chapter in the history of market bubbles? Thanks for watching this explainer, and as always, keep questioning the data.